Hey, here we are, lecture number 38, okay? We only have one more lecture after today, right? Okay, so we are getting to the end of it, okay? Let's go ahead and go through some of the homework. We talked a lot about current liabilities last lecture, and I think I assigned you a handful of problems to do on that. So let's go ahead and go over that. The first ones I wanted you to go through, and we can show those on the overhead. I wanted you to do 11.2 and 11.3, okay? So let's go over those first, but there are those if you need to look at them at home. Okay, let me go ahead and read through those. Quick study 11.2. Dextra Company sells merchandise for $6,000 cash on September 30. Now the cost of the merchandise is $3,900. The sales tax law requires Dextra to collect 5% sales tax on every dollar of merchandise sold, okay? Record the entry for the $6,000 sale and its applicable sales tax. Then record the entry that shows the payment of 5% tax on this sale to the state government on October the 15th, okay? All right, let's do that. Well, let's record the sale that takes place on September the 30th, okay? Let's record the sale that takes place on September 30th. Our sale is for $6,000, right? But as a retailer, you're going to collect more than $6,000. You're going to collect $6,000, which is yours, but you're also going to collect 5% of $6,000, which is $300. Okay, that's not yours. Okay, so even though the customer hands you $6,300, $300 of that you need to book as sales tax payable as a current liability, correct? And of course, don't forget to record the cost of cost of goods sold. Okay, you're going to decrease the merchandise inventory since it went out the door with the customer. You're going to debit cost of goods sold because they tell us it's $3,900, correct? And then a little later, you're going to pay the government what they are due. And so that will be like the payment of any other liability, okay? And so you debit sales tax payable and you credit cash for $300. Is that correct? Okay. All right, questions on that? Okay. And I know we have a homework from chapter 10, right? So don't let me forget to go over that. We will. Okay, let's do the next one. 11.3, quick study 11.3. Ticket sales receives $5 million in cash in advance ticket sales for a 4-date tour of Bon Jovi. Have you heard of Bon Jovi? Do you know who that is? Okay. Record the advance ticket sales on October the 31st. And then they want us to record the revenue earned for the first concert date of November 5th, assuming it represents 1/4 of the advance ticket sales. Okay. Well, we know the revenue recognition principle, right? Which states we recognize revenue when it is earned. When is it earned? When you provide the product or the service, not necessarily when you receive the cash. So in this case, we receive $5 million, but we have to, and you might just have credited unearned revenue, that's fine. But unearned ticket revenue or unearned revenue, and that is a liability account, correct? Because we have not yet provided those concerts, right? So that's for 4 concerts, right? So what happens on November 5th? They have the first of those 4 concerts, right? Bon Jovi comes out, does a concert, comes back for a couple encores. And do you know what the first thing that he does when he leaves the stage on November 5th? He makes this journal entry right here, okay? Because he has now earned 1/4 of that $5 million, which is $1.25 million, correct? So he can decrease by debiting unearned ticket revenue, which is a current liability, and credit earned revenue, or you might have just said revenue. Okay, cool? Make sense? That's the first thing he does, right? And Bon Jovi does all his own accounting. Did you know that? Little accounting, FYI, okay? I don't know if he does. Okay, let's do quick study 11.4, all right? Any questions on 11.2 and 11.3? Okay, let's do quick study 11.4. I'll show that real quick. Okay, on November 7th, Mira Company borrows $160,000 cash by signing a 90-day 8% note payable with a face value of $160,000. Compute the accrued interest payable on December 31st of 17. Prepare the journal entry to record the accrued interest expense at December 31, 2017, and prepare the journal entry to record the payment of the note at maturity. Okay? All right, we can do that. Okay? All right. Did somebody move my chair? Tony, did you move my chair? I did. Okay, let me bring it back. Let's go through this, okay? All right. Quick study 11.2. Okay, now we talked about short-term notes receivable, right? Pardon?
11.4.
Yeah, but in a few chapters ago, we talked about short-term notes receivable. And now we're talking about short-term notes payable, right? So I wanted to once again point out that there's going to probably be a lot of this that seems like we've had it before, and you have had it before. You've had these same concepts when we talked about that, okay? All right, let me pull something out here just a second. Okay, now what's the first thing that they ask us to do? The first thing they ask us to do is compute the accrued interest payable on December 31st of 17, right? Okay. Now, remember the formula for computing interest? Okay, let's take a look at it. We're going to take the principal amount times the interest rate times the time factor. Is that correct?
Correct.
So, when was the inception of the beginning of this note? When was the beginning of this note? When did we incur the liability? What date?
November 7th.
November 7th. And we have to accrue interest between November 7th and December 31st. Is that correct?
Correct.
Okay. So let's do that. We have to know how many days, though, don't we? Now, how many days did you count that had gone by? Okay, you guys with me? Is one mic on? You guys with me? Okay. We're going to take the principal of $160,000 times the interest rate of 8%, right? What time factor did you guys use?
54 divided by 360.
What was that again?
54.
54 divided by?
360.
Okay, did anybody else get that? Mm-hmm. She counted the days between November 7th and December 31st, and it was 54. Now, if you counted 53 or you counted 55, that's fine, okay? I don't really, because some people are like, I don't know if you count November 7th or if you don't. I don't want you to get all worked up about that, okay? If you counted 53 or 55 and your number is slightly different, I would not take off on a test, okay? And if it were a multiple choice sort of situation and you were just a few dollars off because of that, I would just encourage you to choose the multiple choice answer that's closest to what you got, okay? I'm not that worried about 1 day's worth of interest. But if you take 160,000 times 8% times 54 over 360, what do you get? What do you get?
19,200?
1920?
No.
Yeah.
19200.
Yeah. 1920, correct? Is that right?
Correct.
Okay. So that is the amount of interest we have to accrue on December 31st, correct? So we're going to book a journal entry. We're going to debit interest expense and credit interest payable for 1920. Is that correct? And isn't that the second thing they asked us to do? They wanted us to figure out the accrued interest and then prepare the journal entry to record that on December 31st of 17. This is an AJE, right? That's chapter 3, correct? Okay. Now, what's the next thing they ask us to do? Prepare the journal entry to record payment of the note at maturity. Okay? Now, here's the way that I think through this. You might do it differently. But I think, okay, what is the total amount of cash that we're going to have to pay out when we pay off this short-term note payable? Okay? Well, we know we're going to have to pay the principal of how much?
160,000.
160,000. And then we're also going to have to pay the interest. Now, have we paid any interest yet? Have we paid any interest? No, we have not. So what's the total amount of interest that we have to pay? What's the length of this note? How many days in total?
90, right?
Let's see.
90-day, yeah.
It's a 90-day, 8% note, right? So the total amount of interest we're going to pay is going to be 160,000 times 8% times 90 over 360. Again, we use the 360 just because it's a little cleaner math as opposed to 365. Okay, what amount is that when you take that? I believe it's 3,200, is it not?
3,200.
Okay. So the total amount of cash that we have to pay out is 163,200. You with me? So let's start building that journal entry. Okay? Let's start building that journal entry. So we're going to pay out cash of 163,200. We're going to credit that. We're going to debit the note payable, correct? We're going to take it off our books. The note payable was on our books at what amount?
160,000.
160,000. Okay. Now my question is this. Of this total interest that we paid, how much of it still needs to be expensed but has not been expensed? How much?
All of it?
What's 3,200 minus
1,280.
1,280?
Yeah.
Okay. So we're going to debit interest expense for 1,920. Are you with me? Now that journal entry doesn't balance, does it?
1820, right?
Well, are we doing the new? It's what's left is 1280.
Oh, is it 1,8? Thank you.
128.
128.
128. This is just
The 1,820?
No.
1,280.
All right, let's start
Okay.
with 1.
Sorry, Grandpa's getting old. But thank you for pointing out that error.
Yes.
Is that correct?
That is good.
1,280. Okay, I didn't just make up a new debit or credit here. That's a debit, right? And then what do we also debit?
Interest payable.
Interest payable we reduce, right? And how much did we accrue it for? 1,920? Okay, 1,920. Let's see if I can find a little cleaner journal entry for you to look at. Okay. Here, take a look at this one right here. Okay. That's a little cleaner version that didn't have the grandpa mistakes. Okay. Right here. Is that what you guys got? Okay, does that make sense? More importantly, does that make sense while we do that? Okay. Okay, questions on that? Okay, let's, I think we have one more in chapter 11 and we have one in chapter 10. Is that correct? Let's go ahead and do the chapter 11 one first. That's pretty easy one, exercise 111. Is that right? Exercise 111. Exercise 11-1. Yes, not only, I'm being dyslexic on my numbers today, okay? Exercise 11-1. Thank you. Thank you for pointing that out. People are going, he's losing it at the end of the class. Okay, exercise 11-1. The following items appear on the balance sheet of a company with a 2-month operating cycle. Identify the proper classification of each item as follows. C, if it's a current liability. L, if it's a long-term or non-current liability. Or N, if it is not a liability. Now, what is the cutoff for if it's a current liability that we talked about? If it's due within the next 12 months, it's current. If it's not, it's non-current or long-term. Correct. Okay. So, some of these are pretty easy. Notes payable that are due in 13 to 24 months would be Long term. Okay? Notes payable due in 6 to 12 months. Current. Notes payable that mature in 5 years. Long term. This is a real tough one, isn't it? Okay? Current portion of long-term debt. Current portion of long-term debt. Have we talked about that before? We did a long time ago when I think we talked about the current, when we defined current assets. But if you have like a long-term note payable, remember how you strip away the principal portion that's due within the next 12 months? You take it away and you move it up top in the balance sheet in the current section, and it's called current portion of long-term debt. And then down there in the long-term section, you show the long-term note payable except for that current portion of principal. Remember that? That's what the current portion of long-term debt is. So, pretty easy to say which one it is. It's current, right? Okay. Okay, what about notes payable due in 120 days? Current. FUTA taxes payable. We haven't talked about this, have we? Do you know what FUTA taxes payable are? You know what it stands for? Did you look in your book? It stands for federal unemployment taxes. Okay? Now, we haven't talked about federal unemployment taxes, but we can use our logic here. If we owe the government taxes for unemployment, do you think that the government is going to want us to pay within the next 12 months? Yes. So it's a current liability. You with me? Accounts receivable. It's not a liability at all, is it? It's a current asset. Sales tax payable. Again, let's use our logic. Do you think the government's going to want us to remit the sales tax within 12 months? Definitely. It's a current liability. Salaries payable. Current. Wages payable. Current. Again, do you think our employees want to be paid what they're due within 12 months? Definitely. Okay. Any questions on 11.1? Exercise 11.1. Okay. Let me go ahead and put the answers in case somebody at home missed one of those. There's the answers to it. Okay. All right. I think the only other one that we have was, I think I had one from chapter 10 in regards to intangible assets, right? We talked about intangible assets last time. Those are those assets that you cannot touch, you cannot feel, but they help you in your operations, right? So was that exercise 1019? Okay, let's take a look at that. Exercise 1019, I'll show it right there. Right there at the bottom. Okay, Milano Gallery purchases the copyright on an oil painting for $418,000 on January 1 of 17. The copyright legally protects its owners for 10 more years. The company plans to market and sell prints of the original for 11 years. Prepare entries to record the purchase of the copyright on January 1 of 17 and its annual amortization on December 31st of 2017. Okay? Now, in my other class, they thought this was kind of a confusing way that they showed this. But let's take a look at the answer. All right. Okay, first of all, we want to record the copyright on the books when we purchase it, right? So, the answer to that one is we debit copyright for $418,000 and credit cash for $418,000. Is that correct? Okay. Now the question is, do you remember amortization? We talked about that last time. It's the same thing as depreciation and depletion, except we call it amortization when it's in regards to intangible assets. Okay? Same sort of principle. Now, do we amortize this over 10 years or 11 years? 10. Whenever there's two different amounts of time that they give you, you always use the shorter amount of time. Okay? So, my other class said, well, how can they plan to, if they're only protected for 10 years, how can they plan to market and sell prints of the original for 11 years? Did anybody think that? Okay. Well, because you wouldn't be protected. Well, they may plan on doing that, but I don't think they're going to be able to. So we do amortize it over 10 years. So the journal entry, they don't give us any salvage value, which is often the case is with intangible assets. They often don't have a salvage or residual value. So we just take the 418,000 divided by 10 years, and we get 41,800. Is that correct? All right. Okay, that's it for the homework, is it not? Mm-hmm. Any questions on any of that homework? Anybody? Okay. Well, let's talk about some more stuff in chapter 11, okay? What we're going to talk about now is in regards to payroll liabilities, okay? Payroll liabilities, okay? If you have employees, you are going to incur payroll liabilities, okay? And these will be usually short-term liabilities, okay? Almost exclusively short-term liabilities that you're going to have to record to pay out to the government, agencies, or other entities, okay? Let's talk about what some of those are. How many of you have, well, first of all, how many of you have a job? Okay? Now, let's say you work in a given pay period, you work 50 hours, and let's say you get paid $10 an hour. You guys know you don't get, your check's not going to say $500, right? Okay? That's a sad concept that you learn quickly, right? Because why? Because they're withholding taxes. They're withholding other things, right? Correct? Okay? So let's take a look at some of these items. This is your gross pay up here, right? Well, what are some of the things that they withhold for? Well, one of them is FICA taxes. What's another word for FICA? Social Security, right? This is the money that we have to help pay for the elderly who aren't working, right? Okay? So we have to have FICA taxes withheld, or Social Security. We also have Medicare taxes, which is health care expenses for these folks, right? You also have money withheld for federal income tax, okay? They don't just calculate what you owe at the end of the year and tell you to pay all that then. No, they withhold some during the year. Okay, you with me? Then you've got state taxes. Okay? If you live in Kansas, you've got to pay state income. If you live in any state, well, that's not true. Some states do not have state taxes, but most states have a state income tax as well, right? Pardon?
You work at another, like, let's say you work, you live here, but you work in Missouri.
Yeah, which is a common thing in our area, right? Because we live kind of close to a state line. So my wife's employer is in Casey Mo. So we have to do that. We have to fill out a Missouri and a Kansas tax return. Now, some places they also have a local income tax. If you work in Casey Mo, they have a 1% local income tax, don't they? Okay? Then there might be other money that they withhold for other sort of voluntary deductions. Like maybe, Jacob, maybe you have designated that out of every paycheck, you want $10 withheld to go to United Way. Okay? Well, they'll withhold that $10, but your employer has to accrue that liability to United Way because that's not their money, right? Okay? Same thing if you would have said you want to withhold some money to go to a savings account that you've designated for you. Well, they withhold that money, but they have to get it to the proper party, don't they? So they have to accrue liabilities for all these different things, okay? Now, you don't realize how much you should be thanking me, but you should be, because I'm not going to make you book payroll journal entries, okay? I'm not going to make you book these things, okay? Let me show you what one of those looks like, okay? This is an example of a journal entry to record payroll for a period. And you can see all of the different liabilities. Now this is when they actually pay it down here, pay it in cash. But all these different entities, they have to accrue these liabilities for, right? Now I'm not going to make you do these journal entries. You should be thanking me at this time. Now, why am I not going to be making you do those journal entries? Well, for several reasons. Number one, payroll has become such a specific niche of accounting that a lot of companies don't even do their own payroll accounting. What do they do for payroll?
Finance.
What do they do for their payroll? Who does their payroll for them? They outsource it to like Paychex or ADP. Have you heard of some of those companies?
My work use ADP.
Does anybody's company that they work for outsource this? Okay.
We have ADP.
You have ADP? Okay.
We switched it to outsource HR too, so we use Paycom now.
Okay.
Because they outsource HR.
So several of you. Now, there's a lot of reasons for doing that. But there are so many things in regards to payroll that change on a yearly basis. The max amounts, the percentages, all that sort of stuff. It's kind of its own art form, okay? And you can get in a lot of trouble if you miscalculate your payroll liabilities to the government, or if you don't remit them in a timely manner, okay? Now, a lot of companies are like, I do not want to risk making these mistakes, so they outsource their payroll to somebody else who does all those calculations, who does the remittance and all that sort of stuff. Another nice thing about that is that it helps with your internal control. Remember we talked about that in chapter 8? Remember, I think we even had an exercise where somebody made up a fictitious employee and they were paying him. It was the person's fiance or something. Remember that? Well, when you outsource your payroll, you have helped divide up the responsibilities. And if there's some sort of error like that takes place, that payroll company has to pay for it, okay? So a lot of times people say, there's certain things in life you do yourself and there's certain things that you pay somebody to do, right? Okay? And a lot of companies have decided, you know what? I don't want to worry about payroll and all the risks associated with it. We're going to outsource it, okay? So there's a real strong chance that none of you will ever make a payroll entry, okay? If you do, you're probably going to be strictly payroll. And by the time you do it, all the different amounts and rates and stuff are going to be different. This is especially as we talk in December of 2017, they're actually changing some of the tax laws, right? Okay? Because the government cares about you guys, right? Okay. So some of this is probably going to evolve a little bit anyway. Was there a hand up?
I was going to say, my company always did the reason that they use a Paycom service, they wrote us like a letter when they switched over, is purely because they have so many employees, they don't want to have to hire a full payroll staff.
Yeah.
That do payroll for like 5,000 employees.
Yeah. And let me tell you, hiring payroll people is not easy. And just about the time you get them trained, they leave.
Or they'll go to one of the big firms. Like
Yeah,
ADP
or they go to
Paycom.
one of the big firms. You're exactly right. So there's a lot of reasons. So I am not going to make you make that journal entry, but I do want to talk about the general concepts involved. Okay, for example, let's talk a little bit about the employee FICA taxes. Now, some of your money is withheld for employee FICA taxes. You have to pay this. And in 2016, this was 6.2% of the first $118,500 earned in the year. Now, I don't even know what the 2017 amounts are, okay? But that changes every year, that max amount, that $118,500. FICA taxes, it's 1.45% of all your wages, okay? So that's money that your employer withholds. Look at this all from the perspective of your employer. They withhold this money from your paycheck, but they have to accrue this liability because they have to pay these proper government agencies on a timely basis. You with me? Now, you also have income tax withheld for federal and for state and local, correct? So, your employer withholds those amounts from your paycheck, and they have to accrue liabilities for those things as well, okay? You can see how you can get in big trouble if you miscalculate this stuff or if you don't pay it on a timely basis, right? Because you have a lot of the government's money when you withhold this from all your employees, okay? So you remit that to the proper agencies. Same thing with your voluntary deductions. You can go to the slide here. Same thing with voluntary deductions. For anything like savings account or United Way or insurance or whatever, they withhold that amount from your paycheck, but they have to accrue a liability to the proper party, and they have to pay that. Now, that's all money. We're talking about employee deductions, okay? Employers also have to pay payroll taxes, okay? So, Tanner, if you have $200 withheld from a paycheck for Social Security and $100 for Medicare, then your employer has to match that. They also have to pay $200 and $100 for Social Security and Medicare, okay? So these are employer payroll taxes. So they have to accrue liabilities for those amounts as well, okay? Now, one thing that your employer has to pay but you don't have to pay are unemployment taxes. Remember when we talked about FUTA? Okay? Federal unemployment taxes, state unemployment taxes. Okay? When people file for unemployment, this is where they get that pool of money, is employers, not employees, but employers contribute that money, and they have to pay the proper entities that amount. Make sense? Payroll can be a little confusing, okay? All right, any questions on that? Any questions on that? Like I said, I'm not going to make you make those journal entries, but I want you to understand the broad concepts of that. You with me? Okay. Let's talk about, let's move to a new subject here. And we have talked about liabilities where it's a no, we know who to pay, we know how much to pay, we know when to pay, correct? Haven't we talked about that so far? But now we're going to move into a different area of liabilities. And we're going to talk about when there's uncertainty in liabilities, okay? Maybe there's uncertainty in who you're going to pay. Or maybe you're not quite sure of when you're going to have to pay. And maybe you don't even know how much you're going to have to pay. But you know there's a liability, okay? Some of this, dusting off the cobwebs of your brain, think back to chapter 9. Remember when we were estimating bad debt expense with receivables? It's kind of those same principles. You have all these accounts receivables. You just know there will be people who don't pay, correct? But you don't know who's not going to pay. You don't know how much they are not going to pay. And you don't know when they are not going to pay and go into default, do you? There's a lot of uncertainty there, but you know there's going to be people who don't pay on your receivables. Is that correct? So what did we do in that instance? What did we do in that estimate? We estimated it, right? We didn't know for sure, but we can estimate it using past historic data, correct? Remember when we said, okay, we've been in business for a while, we estimate that 2% of credit sales won't be collected. Or we estimate that 4% of our accounts receivable won't be collected. Remember when we did that? And do you remember which principle we were following in doing that estimation?
Is it
the matching? Very good, Tiba. It's the matching principle. This is a good time to refresh our memory on those principles because I like to ask those on the final. The matching principle states that we want to try to match the expense or book the expense in the same period as the revenue that it's related to. You with me? Not a year and a half later. Even if it's an estimate, we want to try to match that expense to the same period as the revenue. Okay? Let's talk about one of these today. One of these would be warranties. Okay? Let's say you buy an item on warranty. Okay? For example, Jacob, let's say that you sell computer monitors or something. Okay? And you offer a 6-month warranty on this, parts and labor. Okay? Well, you have all of these sales of computer monitors, but do you see how, and you know somebody's going to take you up on those warranties, right? But you're not sure of who, when, or how much. Well, this is when you estimate it. Let's look at an example. And again, this is in the realm of looking at your slides This is an estimated liability. It's a known obligation. It is a known obligation, but it's of an uncertain amount, so we estimate it. Okay, let's talk about liabilities, warranty liabilities specifically. Let's say that we're a dealer and we sell a car for $32,000 on December 1 of 2017. Now we have a warranty for parts and labor for 12 months or 12,000 miles. Now our experience shows an average warranty cost of 3% of the selling price of each car. That's not much different than the percent of credit sales we don't think we're going to receive. This is just from our past history, correct? So when we sell that car, we have to book this entry right here. Now we also have to, make the journal entries for the sales of the car, obviously, but we also have to book this journal entry. We take the 32,000 times the 3%, that equals 960, and we credit estimated warranty liability, and we debit warranty expense. That books the expense in the same month as the sale that occurred, correct? So that abides by the matching principle, okay? So that is an example of an estimated liability that we accrue. Now what happens when somebody takes us up on our warranty? Well, let's say on February 15 of 2018, somebody came in, needed some warranty work done on their car. It cost $250 in labor, and we had to use $200 of parts from our inventory, okay, to fix that car. Well, the journal entry we would make is, let me get my pointer going. We would decrease auto parts inventory by crediting it for the amount of parts that we had to use, right? We would accrue that $250 of salaries payable for the labor of $250, and we would reduce our estimated warranty liability by $450. Okay? You with me? Now, should we expect that that 450 should be the same as the 960? No. Okay? This is 3% in aggregate, okay? This is just like, there'll be some people who never use their warranties, right? And then there'll be other people who need warranty work done, and it's probably a lot more than the 3% of their sales price, correct? This is just like home insurance, right? You pay a certain amount of home insurance premiums, and if your house catches on fire and burns to the ground, they give you a lot more money than what your insurance premiums that you paid out were, right? But that's not a problem to them because most people's houses don't burn down, and they're not going to collect it all, right? So this 3% is, we do it by each individual sale, but we're not expecting that each person is going to do exactly 3%. Are you following me? Okay. Questions on that, guys? Okay, let's go ahead and call it a day. And I believe for your homework, it's stated on your homework sheet. There's a quick study I want you to do from chapter 11. There's also a handout that I want you to do. So just, as always, make note of your homework sheet and what is due. And we only have one more lecture, right? So I will see you guys next time. Bye.